All right. Good evening, everyone, or good morning, or good afternoon, or whatever time of day you happen to be watching this video. I hope that you are all doing wonderful, and that you're all having a wonderful day, or that you had a wonderful day, or that your upcoming day will be wonderful, or whatever other kind of combination that I haven't thought of. Welcome back to Online Personal Finance. This is starting to feel like I'm a regular old YouTuber with no subscribers. Yeah, that's right. I've seen that none of you guys have subscribed to my channel, so. All right, well, quick updates for you guys. 615 Mecklenburg County residents have tested positive for COVID-19 as of 8:49 p.m. on April 5th in the year 2020. UNCC is currently allowing students who lived in Holshauser, whatever that name is, Hunt, Laura, Levine, Sanford, and Scott to come in and get the rest of their things and clean out their room. UNCC has offered these dorms to Mecklenburg County and surrounding areas as like makeshift hospitals as the number of COVID-19 patients increases. And hospitals kind of get a little bit too full and they need some room to put some more patients to account for everyone with COVID-19 as well as everyone else that needs to be in the hospital. So if you happen to live on campus and you happen to live in one of those 6 dorms, be on the lookout. Be sure to check your email to get some more information on what that process is going to be like. If I don't know if they're gonna like pack your things for you or expect you to come pack your things and pick them up. I don't know how that's gonna work, but make sure you check your email so you know kind of what the deal is with that. If you did live on campus but you are not in one of those dorms, you're being asked to stay where you are and to not come back to campus at this time. Last week, the whole UNC system, including UNCC, said that they were going to provide students housing and dining refunds for the spring semester. There's unknown status on other refunds like parking, but again, the last update I have is that more info is coming. Big things for this week is that your credit cards and consumer protection quiz, which is going to be based off of this PowerPoint, is going to be due Sunday by 11 p.m. You have 2 grad ready quizzes, 7 and 8, that are also due by Sunday, 11 p.m. And you have exam 2 on Wednesday. And that will be all we're going to do on Wednesday. There won't be a lecture or anything. It'll just be you do your exam. And I think it's going to work like how it worked last time. I'll put the exam on Canvas and I'll send you guys a link as to when it's open, and then it'll stay open for a certain number of hours and then we'll close. And then that will be that. If anything changes, again, I'll be sure to let you guys know. All right, so today we are talking about sources of credit, and we are talking about credit cards. So the ultimate source of credit comes from loans. I've kind of touched on this a little bit. I'm sure you guys have already picked up on this. But when we talk about loans, it's people and institutions giving you money, and you pay them back the principal, which is the initial amount, plus any type of interest that you may have agreed upon with a certain amount of time. So there are 3 basic types of loans. They are inexpensive, medium priced, and expensive. Inexpensive loans are exactly what they sound like. They require you to pay the smallest amount of interest, and that means that they are the easiest and cheapest to pay back. Interest rates could be as low as 1 to 2%. Typically, when it comes to inexpensive loans, parents and family are the most common types of source for this loan, as well as friends, and sometimes it requires no interest at all. Like, for example, if you're going to, I don't know, like let's say you're out to dinner with your friends and your friends forgot their wallet, so you agree to like pay for their meal, and then the next day they give you the $20 that they owe you, and they don't pay you any extra money on top of that. That's an example of like a 0 interest loan. If you do borrow money from friends and family, like extensive amounts of money, like several $1,000s, $100, make sure that you kind of have any terms in writing so there's no disagreement. You don't want to end up like on Jerry or I don't know, whatever, some other type of show, Dr. Phil, for example, and it ended up being like, that family. So make sure that if you have any big things like that, you do have terms in writing, just so everyone agrees on what the conditions of your loan are. Typically for inexpensive loans, you use them for small purchases like paying for food, paying for gas, just smaller things like that. So medium price loans are loans that come with a significant amount of interest attached to them, and they are available at most banks and other institutions. So I have up here, like, you might get a loan to purchase a new car at the 6% interest rate. And typically, the months for the length for the loan range from I just said range twice. So typical months for the length of the loan range go from 24 to 72. Just know that the longer term loan generally means a higher interest rate. So you do get a smaller monthly payment, but you might end up paying like 6.2% or 6.3% versus the 6% you would get for like 24 months. Typically, when you're looking at loans with a bank, you can kind of think of medium price loans as a middle ground between you and the bank, with interest rates between 3 and 8%. Obviously, you would want to get a really low interest rate and not have to pay that much money, but banks obviously would want to have a higher interest rate because that's how or it's not the only way that they make money, but that is a significant way of how they make money, is charging you interest. The most common types of loans that you're going to encounter are probably going to be medium price loans. And the last one, expensive loans. These loans are very, very, very easy to obtain, but they come at a super high cost, between 9 to 25% interest rates or greater, depending on the type of loan. The way that most people kind of get trapped in these loans is that these loans involve small, short-term, high-rate loans. You will hear people call them like payday loans, cash advance loans, check advance loans, post-dated check loans, or deferred deposit check loans, something like that, where you're not talking about all that much money, but I mean you're talking about a super high interest rate that it does become a lot of money. So it's not like you're going to take out a 25% interest loan on like $100,000. You're going to do it on $100 and just kind of get trapped in that debt cycle. And I'll talk a little bit more about this as we get more into the PowerPoint. Expensive loans are widely available at all finance companies, like Quicken Loans. I have a picture up here on the top right. There we go, right here. So like, check cashers, title loans, payday loans, for example. They're available there. They're available at car dealerships, appliance stores, department stores, as well as banks via credit cards. Credit cards are a form of an expensive loan. If you do need a loan and you go to a bank and a bank denies you credit, you should really question your ability to afford a higher rate somewhere else. Typically, where you're going to get the best rates are going to be banks and legitimate financial institutions. If you don't choose a bank like maybe a credit union, for example, that's where you're going to get the best rate. And if a bank doesn't agree to give you a loan you don't typically want to go to like check cashers, for example, to get a loan. Really start questioning what you can afford and maybe what are some other options available to you. Expensive loans get you the cash that you need very, very quickly, but it is sort of like the beginning steps of getting trapped in that cycle of debt. You're short on cash, so you borrow money to pay your bills, but now you're still in debt because you just used borrowed money to pay your bills. So you want to avoid expensive loans at all costs and just use them as a last resort. The only exception to this is credit cards, which we'll talk about shortly. I want to get through the rest of it first. So when you are looking at loans, like maybe to buy a new car or to buy a new house or something along those lines, there are three things that you should consider: interest rates, finance charges, as well as annual percentage rates, or APR. You should always remember that there is the Truth in Lending Act, and the Truth in Lending Act states that federal law requires creditors to state clearly and upfront any costs associated with borrowing with borrowing money, including finance charges and the APR. So there are no quote-unquote hidden fees in a loan or in some type of loan that they're advertising if you actually go in and read the fine print. The way that they're going to bury all of these like hidden fees and charges are going to be in the fine print. So when you are taking out a loan, make sure that you take the time to sit down and read through it, or pay somebody to sit down and read through it for you so that you have a clear idea of how much money you're borrowing and how much money it's going to cost. This also means that you can quickly and easily gather information and compare loans to get the best deal. So, for example, if you are going to buy a house for the very first time, you can look at mortgages from like Bank of America and Wells Fargo and BB&T or Fifth Third Bank, for example. And you can kind of get an idea of where your best rate is going to be and where you can borrow the most money for the least amount of interest. So when we talk about interest rates, the interest rate or the advertised rate, as it's sometimes called, is used when calculating the interest expense on your loan. In other words, it is what it costs to borrow the principal. So for example, let's say you're going to get a mortgage loan for $200,000 at 6%. At a 6% interest rate, your annual interest expense is going to be $12,000. And you divide that $12,000 up by 12 months, because there are 12 months in a year, that's an interest rate of $1,000 a month. Keeping in mind that that includes just paying off the interest on the principal. This does not mean that you're paying back any of that $200,000. You are just paying back the $12,000 interest on the $200,000 loan. So you're not paying back the principal, you're just paying interest. So interest rates can be expressed two ways. And we've already kind of talked about these a little bit a lot earlier in the semester. So there's simple and compound. Simple interest is based only on the original principal. Compound interest rates on loans are based on some type of the principal changing, whether it's increasing or decreasing. So typically, if you are a borrower, like if you're going to go to a bank and get a loan to get a mortgage, you want to have a simple interest rate. Because if you get a compound interest rate and you fail to pay off any of your interest loans, like you don't pay that $12,000 a year that you owe and your balance grows, your principal grows, your interest rate will grow along with it if you have a compounding interest rate, and you're just going to get deeper and deeper into that cycle of debt. And while the reverse of that is also true, that with simple interest, as your principal, if you can make the payments to pay off the interest rates as well as to pay off the principal, your interest will decrease. It's safer to get a loan with simple interest. They're going to offer you the most security, even if it is at a higher cost. So when you are getting out a loan and you're looking at interest rates or comparing interest rates between different banks, that's something that you want to take into account. Is, are you going to be paying a simple interest rate or a compound interest rate? And 99.9999% of the time, you want to go for a simple interest rate. So finance charges are other fees associated with borrowing money. Like I said earlier, if you've ever heard the phrase like hidden costs and fees, it typically is going to refer to finance charges. These are found in every single type of loan that's out there: mortgage loans, car loans, credit cards, other consumer loans, personal loans, student loans, you name it. If there's a loan, there are going to be a hidden cost and fee, and that is going to be a finance charge. So these include things like late fees, transaction fees, maintenance fees, some type of simple. It could be based on the percentage of the loan. It could be some combination of both. Finance charges are just any other types of fee. To give you guys an example from real life, like where I live right now in my apartment complex, there are different ways that I can pay my rent every month. And if I pay my rent using a debit card or a credit card, there's a convenience fee attached onto that. And that's like an example of a hidden fee that my apartment complex didn't tell me about when I signed the lease. So again, I mean, if I had read through the fine print, I would have kind of caught that. And it's not that big of a deal because there are ways that I can pay it without incurring that without accruing that convenience fee that I have to pay to my apartment complex. But that's an example of how they could get you, because if you're kind of going into this mindset of, oh, I'm going to pay my rent every month with a debit card, there might be like a $10 charge attached to that. And, you know, granted, it's only $10 a month, but that's $120 a year, and that's $120 that you're just kind of throwing away, you know? All right, so annual percentage rates. So annual percentage rates represent the total cost of borrowing money. It is going to include interest rates. It is going to include finance charges, any types of other fees, like fees you have to pay to a broker, any type of closing costs, any discounts you get. Annual percentage rates, or APR, is all-encompassing. So therefore, when you are looking at taking out loans, whether it's for a new car, for some type of personal loan, or to get a mortgage to buy a new house, the APR is going to be the rate that you want to look at. It is the more effective rate to consider when you're comparing loans. So let's say, for example, that you're going to get a $200,000 mortgage at 6% interest. Your purchase is going to require things like closing costs, mortgage insurance, loan origination fees, other types of fees that are associated with buying a house. And let's just say that it's in the amount of $5,000 in total. So to determine your loan's APR, you have to add all of these fees back to your original loan amount. So if we take our original $200,000 and we add $5,000, we get $205,000. So keeping in mind we have a 6% interest rate. So if you take 6% of $205,000, that is an annual payment of $12,300. So divide that by 12, which is going to be a little bit over $1,000 a month. That will be your interest payments. Specifically to get the APR, you have to divide the annual payment of $12,300 by the original loan amount of $200,000, and you get $6, or you get 6.15%. Keeping in mind, this references just paying back what it costs to borrow money. It does not mean that you're paying back the principal. It is just what it costs to borrow money. You're not paying back the original $200,000. You are paying back the $12,300 that you get, or that it costs to actually borrow that money. So APR is confusing to most people, mostly because of the finance charges. Yes, you do have that law that says that creditors have to be upfront about any type of charges that they are going to charge you when you're taking out a loan. But banks and other corporations do a very, very good job of varying it and making it extremely complicated for normal, average, everyday people to understand. And it gets even more confusing when you get into cases like where you have multiple different lenders that are offering the same interest rate and the same monthly payments, but for different APRs. Typically, in cases like this, you want to go for APRs, or you want to go for lower APRs. They require fewer upfront fees, and they're going to offer a better deal. APR does come with a few caveats you guys need to know about. The biggest one is that since all associated costs in APR are spread across the entire life of the loan, for as long as like 30 years, for example, if you have a mortgage, selling your house can make your mortgage more expensive than originally suggested by the APR. So APR isn't all-encompassing, but it should be one of the biggest things that you look out for when you're comparing loans. What is the lowest APR that you could possibly get? Because that is going to be the cheapest loan that you could possibly take out. And so you guys obviously know that credit can be dangerous because, if you overspend, you get yourself into too much debt. You kind of get trapped in that cycle of debt, and it's really, really hard to break free. But keeping in mind that credit does actually have its advantages, like we've already talked about, letting you enjoy things now. You don't have to save up $300,000 or $200,000 to buy a house. You can just get a loan from a bank. Credit does have its advantages, and even if you think that the dangers outweigh the advantages, credit is still something that you need to build ASAP. You need credit for almost everything that you do in your life. Even something as simple as like getting an apartment complex. Your apartment complex will probably run a credit check on you to see what your credit score is. And if you have no credit history, that's like having bad credit history. Because people don't know anything about you. And the easiest way for people to start building credit is to just get a credit card and start using it. So you guys already know, because we've already mentioned this, that credit cards are a form of open-ended credit. Loans are made on a continual basis as you use the card. So if you don't ever use the card, there are no loans given to you, or if you use the card all the time, then you have loans constantly being given to you. And if you will excuse me for just, there it is, okay. Sorry, I dropped something. All right, so every month you get a statement from your credit card company that lists all the transactions on your card, and it is your responsibility to pay off that card every month in full. And y'all, if you take nothing else away from personal finance, like I understand that there's a pandemic going on outside, and like this class is probably not your top priority, believe me, I would 100% get that. But if you take nothing else away from personal finance, please, please, please pay off your credit card every month in full. If you fail to do that, it will lower your credit score, which will make it harder for you to obtain future credit, and you will enter into the early stages of the debt cycle. And you guys know that once you get into that debt cycle, it's really, really hard to break out. So when you're choosing your credit card, there are a couple, well, let me say this. There are a couple different things that you want to look out for when you're choosing your credit card. If you don't already have one, if you're 18 or older, which almost everyone in the personal finance class should be, now is the time to get one credit card. But just get one. You do not need more than one credit card. I do not care what anyone else says in your life. As somebody who is like 18 to 30 years old does not need more than one credit card. Even if you're beyond 30, like maybe you could get away with two, maybe, but you really just need one. Do not get two credit cards. Do not take out multiple credit cards. Just pick one. A bank or credit union or whatever institution that you trust your money with is the great place to start if you have no credit history. My first credit card was a Wells Fargo credit card, and it is the card that I still use today. There are places like Amazon and Macy's and Belk and Shell and all these other companies that offer credit cards, but they really aren't the best place to start because, as I'm going to mention in a couple slides, they're not going to be universally accepted. You're going to have higher annual fees. You're going to have higher interest rates. So it's better to just start with some type of credit union or bank or wherever it is that you trust your money. If your bank does not offer a credit card or your bank says they will not give you a credit card, places like Capital One, MasterCard, Visa are the safest alternatives you can go to. So I would say start with your bank, then move on to like Capital One, MasterCard, or Visa. And unless like something catastrophic is going on in your lives, you'll pretty much be able to get a credit card from one of those places. And if you aren't, I'd say go back and talk to your bank and just see what your options are. So when you're selecting your credit card, one thing that you want to keep in mind is if your credit card is going to be universally accepted, because not every place will take your credit card. MasterCard and Visa are probably the most universally accepted credit cards. American Express, Diners, Discover are less accepted, although more places are accepting them nowadays. The way that it works is that you have, well, let me put it this way. So like if I am opening up a flower shop, let's say, and I want to accept a Visa MasterCard, I want to accept Visa or MasterCard. Every year, I'm going to have to pay a fee to the company Visa or the company MasterCard to take my customers' credit cards. And that's another way that these credit card companies can make money. So MasterCard and Visa, when they are universally accepted, American Express, Diners, and Discover less so. If you're going internationally, I would say that probably Visa is more on the side that you want to go to. So like if you travel, nobody's traveling right now, obviously, but if you travel to a lot of different places, like, I don't know, if you're constantly going to Europe or Australia or South America or Asia or something like that, Visa is probably going to be the best bet that you can go with. You also want to make sure that you watch out for annual fees. So most credit cards are going to have some type of fee associated with them that they will give you every single year just for having the card, even if you don't use it. Most annual fees are right around $99. Some might get as high as like, $120, $150, $200. Some might be as low as like $75 or $50. So the annual fees like aren't that big of a deal, but you do want to be aware of them, because if you're paying $500 a year to use your credit card, you might want to consider closing that account and getting a new credit card with a lower annual fee. But the good thing about credit cards is that they do come with rewards, which I think I've already mentioned. So with credit cards, you can get cash back, you can get airline miles, you can get points you can redeem for gift cards or other things. You might get some combination between the two of them. So if you're like, I don't know, if you're a really big traveler, getting airline miles might be a really big deal for you. My Wells Fargo credit card has points, and I can use those points and convert them into cash, and it's $1 per point. So if I have 270 points on my credit card, I can get $270 in cash in my checking account. I can also use them to purchase things like an Amazon gift card or a Netflix gift card or a Visa gift card. Or I think I can even purchase airline miles with them. I've never done that, but I think that's an option available to me. When you do get your credit card, whatever company you go with to get your credit card will initially come with a limit. Well, I shouldn't say initially, because your credit card will always have a limit to it. But every card is going to have some type of limit or how much money you can put on it every month. The credit card company will occasionally increase the limit. And every once in a while, like I'd say once or twice a year, you can call them and ask them to increase it. My starting credit card limit was, I think, $1,000. And I think now my credit card limit is maybe $1,900, maybe a little bit more. I'm not 100% sure, actually. Wow, I should know that. But no matter what your limit is, make sure that you spend 10% or less of your credit limit. So if your credit limit is $1,000, put no more than $100 on it per month. I do not care if you pay off that credit card more than once a month, or whatever your situation is. Just use your debit card, use cash, write a check, do something else other than just put money on your credit card. Even if you can afford to pay it off in full every single month, if your credit limit is $1,000, don't be putting $900 worth of charges on your credit card every month. It just doesn't look good to credit card companies. It makes them nervous. And the less you spend of your credit, the higher your credit score will be, because it shows that you're more trustworthy with it. What credit card companies like Visa or MasterCard or like even Wells Fargo like to see is people who have credit and don't really ever use it. So I would say start by just making like small purchases on your credit card, like paying for gasoline or like fast food or like um, you know, $5 here, $10 there, just like really, really small amounts. Like I use my credit card. I think I just use my credit card for gas. There are a couple of times I'll use it, like when I'm in the grocery store if I'm just making small purchases. But for everything else, I use my debit card. Um, I don't know why 10%. I don't know what the logic is behind that, but I do know that that is a hard and fast rule. Well, I mean, you can use more than 10% of it. It's not like you're going to get banned if you do, but you need to aim to spend 10% or less of it. The less you can use your card, the better, as long as you are using it. And you also want to take a look at interest rates for your credit card. If you do not pay your card off at the end of every month, your interest rate will kick in and the bank will charge you. And interest rates can be 20% or higher. So let's say, for example, you put $200 on your credit card at the end of the month and you fail to pay it off. With an interest rate at 20% at the end of the month, you're going to owe the bank an additional $40 for a total of $240. Now, this is important. Interest on credit cards are compounding. They are not based on simple interest, it's a compounding interest. So next month, assuming you don't put any other charges on the card, but you don't pay off that $240 that you owe, you're going to owe an additional $48, because 20% of 240 is $48. So if we take that $48, add that to the 240, we get $288. So now that's like $88 that you've essentially like thrown away. I mean, if you need to pay off your credit card, every single month, because it lowers your credit score when you don't, and the interest rates are just so high, it's ridiculous that it is so easy to get trapped in that cycle of debt. Most people, when they get trapped in a cycle of debt, are going to get trapped like by overspending on credit cards, and this can lead you to getting into too much debt. So obviously, you guys know that it is very easy to get into too much debt, whether by overusing your credit card, taking out a loan with too high an APR, or it could be a situation entirely out of your control. You lose your job because there's a pandemic outside. You walk outside and you fall down the steps and break your leg. You could be like my aunt and go and check your mail and somebody hits you with their car. At some point, too much debt is going to be something that most people are going to run into. And if you find yourself in a situation like this, there are options that don't include just borrowing money and getting trapped in the debt cycle. You see commercials all the time for like debt consolidation, and that can be a really good thing, but most of the time you're just borrowing money to pay off all your other debts, and you're going to end up with a really high interest rate on that type of loan, and you're really no better off than when you started. So the first place that you should turn to is a consumer credit counseling service, otherwise known as the CCCS. They are local nonprofit organizations that are affiliated with the National Foundation for Consumer Credit, or the NFCC, and branches of the CCCS provide debt counseling services for families and individuals who face serious financial problems. It's not a charity, it's not a lending institution, it's not a government or legal agency. It cannot represent you in court. It's not going to give you a loan. Well, it might give you a loan depending on your particular branch that you go to. But typically, they're not going to give you some type of loan. They're just supported by banks and credit unions, merchants, as well as other organizations and individuals that want to help people. So the goal of a CCCS is to, number one, help families and individuals that have serious debt problems by essentially giving them a crash course in personal finance, kind of like what we've been doing this semester. It helps them set up like some type of realistic budget, plan for expenditures, plan to repay those debts, and make not only those interest payments, but also help pay back any of those principals associated with those loans. So it helps people, it helps you prevent yourself from getting into further debt, as well as helping you get out of debt. And it teaches you things like, budget planning, teaches you education for like, unwise credit buying, like, I don't know, going and buying a boat with your credit card, for example. And it helps you kind of look at those fine print terms, like those finance charges that, all of those hidden fees. So a consumer credit counseling service should be the very first place that you turn to. If you go to a place like that and they find that it really cannot help you, at some point you may decide to declare bankruptcy. Bankruptcy is kind of like a last resort, but it is an option available to you. So I kind of have the meme up here from The Office. If you guys ever watched that, it's Michael Scott saying, "I declare bankruptcy." It's a little bit more complicated than that. Bankruptcy is a legal process in which some or all of your assets are distributed to your creditors, people or institutions that you owe money to, because you are unable to pay off any of your debts. You just owe so much money and you will never make enough money to be able to pay off that debt. And you're facing things like homelessness, other really serious issues because you're in so much debt. Bankruptcy can include a plan for you to repay debt to creditors based on an installment basis, and it can also involve loan forgiveness, meaning that your debt just kind of goes away. Again, it is a last resort because it severely damages your credit rating, and you will have a very difficult time obtaining credit in the future, like if you want to buy a house or get a car. You will still be able to obtain credit probably, but it will be with a very high interest rate. So there are two types of bankruptcy that you guys need to be aware of, and that's Chapter 7 and Chapter 13. And these are taken from the Bankruptcy Abuse Prevention and Consumer Protection Act of 2005, also known as the BAPCPA. A lot of acronyms this lecture. So Chapter 7 bankruptcy is probably what most of you guys are familiar with, and it's like the most traditional form of bankruptcy. What you do is you drop a petition of all of your assets and your liabilities, and you give it to a U.S. District Court. And in that kind of scenario, most or many, a lot of your debts are going to be forgiven as your assets are sold off to pay off creditors. So like, let's say, for example, that you have $1 million in debt and your assets total $500,000. All of your assets are going to be dissolved. They're all going to be sold and liquidated. And then those $500,000 will be distributed to your creditors, and the other $500,000 are just going to go away. There are some assets that you can keep, like Social Security or unemployment benefits, but most things like your house, your cars will probably just be sold like at auction, and the money from that redistributed to your creditors. So Chapter 13 bankruptcy, a lot of people call this a wage earner's plan, means that you can declare bankruptcy even if you have a steady job and regular income. So what it involves is you kind of come up with some type of plan to pay off your debts using future earnings, either from your job, or like maybe you want to sell off your house and buy something really small, or sell off your car and buy or just use public transportation. And you kind of come up with a plan of paying back all of your debts within a certain period of time. In this case, you actually get to keep a lot, or at least most of your property. You're not required to like sell off everything like you would be in a Chapter 7 bankruptcy. So during the plan, while the plan is in effect, which can be as long as 5 years, you'll make regular payments to like a Chapter 13 trustee, who will then distribute the money to the creditors. With Chapter 13, there is some loan forgiveness, but it's not going to be as much as Chapter 7. I would say that if you're going to go the bankruptcy route, you want to explore Chapter 13 before you start exploring Chapter 7. And some type of lawyer will be able to help you more with that, kind of like the legal ramifications. Once you declare bankruptcy, though, you have to keep in mind that your credit is shot, and it will just be shot for like the rest of your life. And it will be extremely hard to ever recover from bankruptcy. Most are going to find obtaining credit more difficult, and your interest rates and your APRs are going to just skyrocket, and you'll just find yourself in a really impossible situation. Some people find that they have that like obtaining credit is easier because they no longer have any life of debts hanging over their head, and creditors know that like you can't file bankruptcy again for like another period of time, so they might try and go after you like that. But I mean, for most people, I would say that you're going to have a really hard time keeping up, or you're going to have a really hard time with credit once you file for bankruptcy, no matter if it's Chapter 13 or Chapter 7. In either case, use bankruptcy as sort of a last resort option. When they're just, again, there really is no other option available to you. So that's it for today. So keeping in mind, it is now no longer 8:49. It is now 9:22. There we go. It is now 9:22. So your credit cards and consumer protection quiz are due Sunday by 11 p.m. As are your grad ready 7 and 8 quizzes. And exam 2 is going to be on Wednesday, and I will send out instructions for how to do that just as soon as I can. Please make sure that you guys take the credits, or you take this associated survey on Canvas. It will count for attendance. As always, I know that I noticed that some of you guys don't actually respond to it. Thank you for those of you that do. I see you. I appreciate you. Your attendance has been noted. But part of the way that I can use these surveys is to check kind of your understanding. And if you guys like aren't getting something, or you have an idea, or you want to ask me a question, that's kind of the best way that we can do this. As a side note, before I forget, this Friday I'm going to be going out of town, and I'm going to have limited access to the internet. So if you guys want to send me an email or message on Canvas and have a question about personal finance, my access to internet is going to be a little bit limited, so it might take me like 24 or 48 hours to get back to you guys. But that's it. That's all I have for you guys today. I hope you guys are staying healthy, staying happy, staying calm, staying sane. These be trying times, yo. Trying times. Well, I guess I will talk with all. Actually, I guess I won't talk with all you guys on Wednesday because I won't be recording a video. Oh, I guess I'll send you guys a message on Canvas. Well, that's it for me for today. Anything else I want to think, or anything else I can think of? Nope. Bye, everyone. Have yourselves a good rest of your day.